Good evening, everybody. Thank you for joining our webcast this evening, The Short and Long-Term Effects of Stimulus Efforts on the U.S. Economy. I'm Dave Duffus. I'm the president of the TMA Pittsburgh chapter, and in my day job, I'm a partner with HKA Global. Before we get started with the program tonight, I want to just take a minute to thank our TMA Pittsburgh annual sponsors. We would not be able to be here without their generosity, and it's only because of them that programming like this is possible. Their logos are being shown on your screen at this time. If you are interested in becoming a sponsor, please let me know or reach out to Michael Whitfield, Director of Business Development for TMA Pittsburgh. We have more exciting virtual events on the horizon, and fingers crossed, we'll be returning to in-person events very soon. As we do that, we'd love to have you all join us. I'd like to just take a minute now to introduce the individuals who are on our panel this evening. First of all, let's welcome Colin Gleason, Director with Gleason Advisors. Colin is going to serve as the moderator this evening. We have Jim Glassman, Managing Director and Head Economist with JPMorgan Chase & Company. Ahmed Olnacali, Head of Capital Markets at FNB. And Jeff Mortimer, Director of Investment Strategy at BNY Mellon Wealth Management. If you have questions during the course of this panel, please use the Zoom Q&A function to type in your questions. We will be monitoring any questions that come in, and they will be answered as we go through the webcast. So with that, I'd like to hand the program over to Colin.
Thanks, Dave. Appreciate it.
You're welcome.
Welcome everyone. Look forward to a productive conversation with our panelists. As Dave said, my name is Colin Gleason. I'm a director with Gleason and Associates. Our firm specializes in financial matters such as investment banking, dispute resolution, business valuations, and so forth. Very impressive group of panelists across a variety of backgrounds, economic, fixed income, equity type backgrounds. Obviously this is the TMA Association. We have a wide variety of experts that are going to talk, I'd say, broadly on markets, but try to tailor it to the extent we can to the turnaround and the restructuring industries that you all participate in. So with that, I'd like to hand it off to Jim Glassman to introduce himself, and we'll go around in a circle and have everyone just give a brief bio on their backgrounds.
Hi, Jim Glassman. I'm the head economist for JPMorgan Chase's commercial bank. I've been there for 33 years or so. I was at the Fed in the 1980s under the Volcker era. So an amazing time, actually. It's a fun time to be an economist.
Hi, everyone. I'm Ahmed Olnacali. I'm head of capital markets at First National Bank. I've been with the bank now for 5+ years. Prior to that, I spent the vast majority of my career overseas, both in London and in Dubai, mainly focused on currencies, commodities, and fixed income, and how we can mitigate these risks for corporate clients and sovereign wealth funds and the like. Anyway, excited to be here. I think it's a fascinating time to be talking about this. So thank you.
Of investment strategy for BNY Mellon Wealth Management. In this role, I set capital market assumptions. I chair an investment strategy committee. We set tactical views looking out 12 to 18 months on all major asset classes. I'm not an economist by training. I've been a student of markets for some 30 years. I was, prior to this role, was CIO of Charles Schwab Funds, and have been with BNY Mellon Wealth Management for coming up on 9 years.
Well, appreciate it. Obviously, the topic of today's conversation is around the effects of stimulus on the U.S. economy. I think a good place to start would just be what are the stimulus that have been put into the economy? both fiscal and monetary. Looking at you, Jim, obviously we all see trillions of dollars every time we open up the newspaper that are, proposed or being enacted, both fiscally and monetarily. Can you maybe just give, all of the people that are viewing a sense for, what has been enacted, what was the goal, and kind of, what's being proposed going forward?
Yeah, and this is a really big part of why it is that this event is playing out very differently than people expected. And from a turnaround perspective, the financial distress is nothing like what people imagined a year ago, when we, the banks, had to set aside massive amount of reserves on the assumption that there was going to be lots of dislocations. So here's what's done. And honestly, by the evening of March 27, before the ink was dry on the CARES Act, I kind of had a sense that this is what was that this policy response is what was going to make this very different. I sort of defer to the Committee for a Responsible Federal Budget, nonpartisan agency, to keep a tally on all these different things that are going on. The first 4 congressional initiatives, by the time we got the CARES Act, plus the executive actions by the White House, pretty much authorized the release of about $4.5 trillion to be spent for various kinds of things: checks in the mail, supplemented unemployment insurance, funding a special unemployment program for people who are gig workers who they don't have eligibility for unemployment insurance, and various other things for the airlines, for the healthcare system, for municipalities. Then, the guts of that help was really aimed at trying to replace lost income for furloughed workers. That's where a lot of it was. Honestly, out of that first round of response, to me, the most innovative and interesting program was the Paycheck Protection Program, which gave resources to small businesses to handle their problems, gave them free loans for 2 months if you put your workers back on your books. That would have been, benefit of hindsight, that would have been the smart way to go. But we probably would have spent a lot less money in this whole thing had we gone that way and made it open-ended. But then around Christmas, they passed another $900 billion to extend a lot of those unemployment benefits into March. And then when the Biden administration came in, we got another 1.9 trillion. So here you are on the fiscal side, you're talking about roughly $7 trillion of money that has been authorized to support the economy. On top of that, you look at what the Fed's doing. The Fed's got short-term rates at 0. They've been buying $80 billion of treasuries every month, and another 40 billion of mortgage-backed securities. And the aim of all that is to keep long-term interest, to suppress long-term interest rates. Doing a pretty good job of it, if you ask me, because 10-year yields 160. That's not normal. That's about half the level that you would expect. And this is all because of what the Fed is doing. Eventually, they're going to have to start thinking about unwinding that. But here's just one cautionary note on all this. In my mind, this is why it is. Basically, effectively what we're doing, what a lot of these efforts did is they're giving furloughed workers paid leave. And this is why when you look at what happened in the economy last year, it's why the consumer sector came bolting out of the gate. By late summer, consumer spending was about where it was prior to the crisis. The whole business community, anybody who works in the goods world was thriving. Probably did better than they would have without this, had there been no pandemic, because all of us are trapped at home. Nothing stopping us from shopping online. So anything physical, I can get online. And this is why all this fiscal support really gave consumers, households, the resources to spend when we allowed them to get back to, go to the restaurants, bars, fitness centers, do things. And by the way, it's indirectly related, but when you think about 2021, not only do you have a lot of money in the pipeline still, but consumers couldn't spend a lot last year. There was a lot of deferred spending, and we economists think there's about $2 trillion of money sitting in the bank that consumers, extra saving beyond what they normally would do, which means they've got the wind at their back because of all this fiscal support. And you might look at this and say, well, gee, we're spending all this money isn't this going to be inflationary? The only thing I would caution you on is all the money that we're spending, the $7 trillion, despite that, national output is not yet quite back to where it would have been had there been no crisis. So what it tells you is that a lot of the fiscal support here was aimed at offsetting the loss of private activity, private support. And, so this was very different from normal business cycles, but this would have been a complete nightmare. Had Washington frozen and not done anything, we would be talking about Great Depression kind of stuff. So that's the important thing to keep in mind when you think about all this money we're spending. It is working. It's making a difference, and I think it's the reason why we all are pretty optimistic that we're going to get back on our feet right where we started. Maybe later this year, maybe early next year. It's not too far out in the horizon.
So, Ahmed, I want to turn to you. I think Jim touched on a little bit of, what the Fed did in terms of, their, I'd say more on the monetary side. You obviously specialize on the interest rate, side of FNB. What do you see, in your world? Obviously over this last month, a lot of the talk has been around, inflation starting to jump, and I think the Fed saying that they have a handle on it, and that it's transitory. But what do you see as some of the risks to the economy from an interest rate perspective, and what is the Fed doing to try to combat that?
Yeah, that's a fascinating topic. I guess let me first start by picking off on where the Fed actually stepped in. So obviously we know from Jim's comments that there were and there continue to be large purchases both of treasuries and mortgage-backed securities. One of the interesting things about the US is the flow of credit is primarily through capital markets in our country, unlike other countries where it's primarily through the banking system. So what the Fed did in their extraordinary response, in addition to lowering rates and buying long-term bonds, is that they helped to unlock capital markets. And a lot of what they did, it caused this to go through relatively painless, in a painless fashion from the depths through the summer, right? They came in with a large backstop. Now, when we focus on rates, yes, they took rates low. The 10-year Treasury at one point hit 51 basis points of August of last year. It's at 160 now, and it hit 175 earlier. Now, the economic data would suggest that this rate would be significantly higher. Economic models that we grew up with tell us that the yield investors demand on 10-year Treasuries should equal not only inflation, but where we expect the economy to grow. And that's setting aside term premium of holding dollars in place for 10 years, right? And at 1.6, that drastically undershoots it. Now, what this has caused is a binge of not only corporate debt, but government debt to support all the programs that Jim mentioned. So Colin, to your question about where do we see possible risks because of low interest rates, there has been a flood of issuance, both on non-financial corporates and obviously the government space. Do we think any of this is worrying and to cause what we would say a bubble, an asset bubble? No, I don't think it's there. But the main thinking is if interest rates rise to levels once the Fed stops to support long-term rates, will we have certain segments in certain industries which have overindulged in debt, and will they now be able to support those debt levels? I think that's one of the things that worries me personally about the debt levels, but I'm not suggesting that the Fed did anything inappropriate. I think this was an extraordinary crisis, and now it's been an extraordinary recovery, one that a lot of economic models just don't have the precedent to show how we will come out of this.
One follow-up there, I like to look at things visually and graphically. I mean, when you look at the Fed's balance sheet, it's almost hard to wrap your head around.
It is.
And I guess my question is just, what does it all mean? And others can jump in, but it's it almost seems like an experiment, that's unfolding in front of us. And I don't know what my question is just simple. Like, how does this end? Because, we've seen in the past where they've tapered back their purchases of treasuries and, markets puke on that. So it's like, where is this going and what does it all mean?
So just to, I'll take a shot at sort of quantifying what this balance sheet is. From March of last year to December of last year, the size of the Fed's balance sheet jumped from about 3.9 trillion to about 6.6 trillion. To your point about this being an experiment, yes. I mean, we think of the Fed as primarily impacting monetary policy by setting a short-term interest rate. They expanded their playbook through the last crisis, and they've continued to expand and take on additional roles. In 2013, when they were talking about tapering, there was a hiccup in the markets. We saw 10 years jump about 1% in the span of 2 months. Now, you're probably, the big phrase now is we're not even talking about lifting interest rates. And that's correct, right? Because we're still purchasing bonds on the long end. You can't think about lifting interest rates on the one hand, on the short end, while you're continuing to ease monetary policy by purchasing bonds. So the real conversation, and it came out, it flushed itself through the minutes yesterday of the Fed meeting, was at what point do we talk about the tapering effect? When do we slow down this $120 billion a month of Fed purchases? That's step one. How the market will react, I'm curious. I'd love to hear Jeff's opinion about this, not to put him on the spot, but I think that is that's a very interesting thing that we're about to see.
Well, teed you up, Jeff. What's this all mean? I mean, I think, when we look at, obviously you're the equity guru, but I mean, whether it's commodities or, cryptocurrencies or whatnot, I mean, everything is going up, and it's, I would imagine, somewhat of an effect of what Jim and Ahmed are talking about. But where do we stand from an equity market perspective?
I think everything did go up. I don't know if everything is still going up. Certainly there's been a massive rotation underneath markets over the last couple of months, which really started in the fourth quarter of last year. Growth started to give way to value as the markets began to anticipate a reopening trade. Certainly in the crypto land and in other individual companies, you did perhaps have valuations which were dependent upon very easy money from our central bank and central banks around the world. And as rates began to rise on the long end of the curve, bond vigilantes, to use a loose term, sort of began to at least moderately take over. And it certainly did have repercussions, in my opinion, in some of those price to perfection type assets. So I don't think markets overall are overvalued. In fact, if you look at how strong earnings continue to come in, first quarter earnings beating estimates by almost record levels, we are getting back to fairly easily should beat 2019 earnings in 2021. So it's as if 2020 sort of never happened. The bridge that was built by both fiscal and monetary stimulant in this country worked. And now it's just a question of, how do you sort of take that away and what value do you start to put on equities? But multiples have come down. Earnings have been so good that as you look out now into 2022 earnings on the broad S&P 500 now, you're down below 20. And I think markets are coming to the realization that the path or least resistance of rates, as my other two panelists have mentioned, is probably higher in the near term. The 10-year tends to trade historically around the nominal level of GDP growth. Those are rough. It's a rough number, but it's been mentioned by others already on this panel. And so 1.6 is artificially low. And I think markets know it's artificially low, so I think some of that is beginning to get priced in. But certainly we know if inflation surprises on the high side, we know it has a downward impact perhaps on multiples. And we know mathematically what it does to bond prices as well. So I think, again, we think lower for longer in here for rates. I don't want to scare anybody on this panel by my comments, but certainly I think markets will have to come to terms with interest rates moving higher. I think sort of purposely higher. I don't think there's any spike in here, but purposely higher as the economy continues to expand.
Hey, Colin,
Yeah.
can I add something that's important for people to remember? We don't worry about the Fed's balance sheet anymore. And the reason is because the Fed has changed the way they operate in markets. So when they went through all those QE a decade ago, we thought to ourselves, the market thought, oh my gosh, the Fed has built this big balance sheet. Now they're going to have to unwind it. Well, when they came into 2018, they told the market they're going to operate differently. They're going to hang on to that big balance sheet and just have run things with a lot of excess reserves. They used to be that they would come in day to day, try to keep the supply of reserves in line with the demand for reserves. Now they're not worried about it. They're going to keep a big balance sheet, boatload of reserves, and let the Fed funds market operate that way and use other administered rates. So if people are thinking, oh my gosh, what's going to happen when this is over and the Fed is going to try to shrink their balance sheet, they may just shrink it organically over time as needs build, but it's not going to be an event. I don't think you're not going to. There's not another shoe to fall when the asset buying is done, and we learned that in 2018. That was a real big deal for the market because there was always an anxiety around about what's going to happen when they bring their balance sheet back down to where it was before the 2008 crisis. And my guess is you're just going to see the Fed living with a much bigger balance sheet than they used to.
And I guess when you apply that logic to industry, so if rates start to normalize, right? I mean, I guess that's a question. Do we see the 10-year going to where GDP is, or do we see it? Everyone I think believes that rates should be higher, but will they ever get there? And then Jeff, what does that do to specific industries? I mean, you have these tech stocks that are flying high. They're all valued pretty high and they're all growing really strongly. But does elevated interest rates change how investors look at those stocks, and do people start to rotate into more value based? What's the landscape look like if rates ever increase?
So history teaches that value beats growth whenever the economy is surprisingly strong. So I think that the COVID-19 vaccines have the ability, now I've been saying this now for months because we didn't know for sure, but certainly have the ability in this country to turn our economy surprisingly strong like a light switch. And that seems to be in fact playing out so far in this country. You're seeing it also in the UK, not so much in the emerging world as we all know. Whenever you are surprisingly strong, and this again, speaking of turnaround situations, you want to be in those sort of value type names. Everything from, right, we all know where they sit, energy, financials, but even Main Street type companies where turnarounds now are possible, where people have not gone out face to face. And as we continue to open up, I would be spending my time, if looking at turnaround situations, at those firms and industries, sectors, industry groups, which have been most hardly hit by the pandemic and are just now sort of getting back on their feet. I think markets will reward those companies going forward. Some of them, have in the public markets, airlines are of course up a lot, cruise lines is getting good news today. So you're seeing it sort of slowly but surely sort of trickle into the public markets. But public markets to me are just a signal into the private world, although most restaurants are not publicly traded, right? So I think there's those industries where I would begin to play or to have my attention would be those that will benefit from what we call the broad reopening trade. That's what I think again. And it fits with value over growth and a surprisingly strong economic.
And Ahmed, how do you think about bond investors? I mean, if there is some increase in inflation and there's been a 40-year bull market in kind of the bond world, is that the wrong place to be right now? Where do you see that trending over the medium to longer term?
Well, do I think rates will go lower from where they are today? No, but it's a very difficult thing to say after a 40-year bull market in probably one of the biggest asset classes in the world that the bull market run is over, right? A lot of people have died on that statement. One thing that I always think about when we talk about rates in the US, long-term rates, we can do the economic analysis, and I think it all points to higher levels of interest rates on what Jeff was talking about, it correlating very nicely to GDP growth. However, we have to understand the global nature of what we preside in. We currently have roughly, give or take, $12 trillion of global debt, which is trading on a negative yielding basis. Even when you factor in the cost of hedging, both from Japanese investors and European investors, we are at these levels a very attractive place to park capital, right? We benefit from having the deepest capital markets in the world. Our rates are higher than most of the industrial world. So it does create this countervailing force and a little bit of a cap on where rates can actually go. So we talk about inflation. We say, is it transitory? Is it not transitory? Again, a lot of this has to do with base effects. And for those who are listening, that's simply a year-over-year comparison. 12 months ago, I think we were all scratching our heads when we saw oil futures, basically going below zero. And that's the level that we're actually comparing to this May as compared to last May. So I don't want to call the end of a bull market. That's a really difficult thing to do. But I do think that while rates will continue to trend higher, there are natural forces keeping them somewhat contained.
Got it. Jim, how, I think switching to how do we pay for this? I think there's been some proposals, from the Biden administration that have come out, of late. I think they seem to be aggressive in terms of, in their nature. I think the numbers that I've seen, 28% on ordinary income, potentially up to 43% on long-term capital gains. What other measures are they looking at? What's doable? And, kind of what does that mean for the economy?
Well, from an economic point of view, paying for the current debt that we're issuing to take care of this crisis is not the issue. And that's why interest rates are, not only is the Fed buying a lot of it, but that's why interest rates are low. The real issue for the US economy is not about the crisis, not about today. It's about this imbalance that is brewing, and the Congressional Budget Office has been telling us about this for a decade. As you look into the future, what's happening is we've made a lot of promises, Social Security, Medicare, Medicaid, but we could pay for them. There would be no issue if the U.S. economy could continue to grow as fast as it did in the last century, 3.5% on average. But because of our demographics, they think that we're going to be growing at half that pace. That's the issue, not what the administration is talking about. Doesn't even, to me, does not really focus on that issue, because the real answer, there's three ways you can solve this problem. If your revenues are not going to grow as quickly as your promises, you can do it either by raising taxes, by cutting spending, or by getting new energy in the U.S. economy. Getting new energy in the U.S. economy is the smart way, the only way, because if you decide that you're going to try to fix this fiscal imbalance by raising taxes, you're going to find that it does more harm to the economy, and it just drains the ability for the economy to generate the kind of revenue. So what we're facing today is very much like what we faced when we came out of World War II. The debt was 100% of GDP. And by the late 1960s, the debt level was down to 20-something% of GDP. And the reason was because we had a virtual boom. And it's not hard to imagine how you could make that happen. Infrastructure investment done the right way is one way. Immigration reform is another, to offset this massive demographic thing that's going on. So to me, I think what you're hearing, I personally think that what you're hearing, when the country is very divided politically, and when Washington is about as narrowly divided as you've ever seen, it's pretty unlikely in my book that you're going to see an aggressive tax agenda get through. And particularly when, and I think it's noteworthy when you're thinking about the corporate tax, just remember what Janet Yellen told Congress in her nomination hearing. We need to have an agreement. We need to have a coordinated effort with our partners around the world on setting a standard for corporate taxes. That tells you we know that if you get the U.S. tax code out of line with everybody else, you're going to do a lot of harm. But the problem is nobody else in the rest of the world is very enthusiastic about raising corporate taxes. So I think this debate is not going to go very far, particularly when you have the Senate 50-50, and it only takes one moderate Democrat to bail out. And I think it's just not going to happen.
Jeff, what are the equity markets? What's their read on the situation?
Worse than bite. I guess that's 4 words. I think markets are really listening to Biden and his proposals, but really look at them as a shot over the bow and a beginning of negotiation. Markets, in my belief, if they thought that a 43% capital gains rate was going to bite in, I think you would see some selling. You may see it later this year, right? Who knows about that? Our firm has done some work on past hikes within the capital gains historically. Reagan did it. He cut income taxes but raised cap gains. So that's a tough one to see. But Obama raised capital gains rates, and markets sort of took it in stride. Jim's hitting it on the nail on the head. Markets are going to care. I think even if you raise capital gains a few hundred basis points, 500 basis points, whatever the case may be, I think that's a small enough number that it doesn't change investment behavior. And markets sort of withstood higher capital gains rates early in Obama's presidency. He proposed it in 2010, did it in 2013. And markets over those period of times were paying attention to how we were putting new energy in our economy, how we were growing our economy and coming out of the financial crisis. So I think markets, as long as they're not onerous, 43, I think would get the market's attention. And then don't forget that people that don't sell at the lower rate, 43% would then, I think, serve to freeze capital in place, a seller strike, as it were. And whenever you remove sellers from an equation, that puts upward pressure on price overall because nobody's willing to sell to pay the capital gain. So I think it might be a market sells off, for people to realize those the lower capital gains rate, but then it becomes frozen. It's inefficient allocation of capital, of course. We all know that as students of economics. But again, I'll get back to my bark worse than bite. I think markets they're right. They're strategizing about all these worst case scenarios, but I don't think they're priced for much more moderate, sort of both sides working together, perhaps, to come to a more moderate conclusion.
Sure. When we think about the U.S. consumer, what type of shape is the average consumer in? Jim, I know you were talking about $2 trillion of money that's in people's bank accounts. With the vaccines rolling out, with economies beginning to open up, I mean, how should we think about the economy in the reopening trade, and what does that mean for industry?
I can't think of another time when the consumer was in better shape than they are now. Just think about what's happened. House prices have gone up 10, 15% in the last year. 2/3 of Americans own their houses. Net worth of the household sector is off the charts. Despite there was a lot of people got furloughed, but the financial support was pretty generous, and so much so that a lot of businesses are complaining they can't lure people back to the job because we've overcompensated temporarily. So I think at the end of the day, we're in really good shape. I can't think of another time when there was more wind at the back of the consumer than what you're seeing right now. And the thing that's interesting to me is that for all the wealth that's been created in the last decade, the rise in net worth, you haven't seen, most Americans have been very cautious about how they respond to that. They didn't, unlike the 1990s, they didn't end their saving and go on a spending binge. It might be because as a nation, we're getting older and people tend to get more conservative. There may be some stories behind there, but I think there's nothing worrisome that I see on the consumer front.
And what about, when you think about these numbers, is it, some of these headline numbers seem almost, just general, right? But when you break it down, I mean, is there a disparity in when you look at, the top quartiles or two quartiles of the savers, and are there growing inequalities that, threaten the system, or, is there anything there that, on surface seems like a good thing, but, when you dig deeper, there's maybe growing things on, underneath the covers?
Well, there has been a growing income divide for the last decade or so, which has got everybody's attention. That's all about innovation in my mind. It's about the Amazon phenomenon that's transforming retail. So there's a lot of jobs disappearing. There's a lot of jobs we need people for, but they don't have the skills. But the pandemic itself and the way we responded didn't make that worse, despite what you hear on the airwaves. And you know how you tell? If you look at credit card charges, thanks to MasterCard, look at credit card charges by income strata. And what it shows is that the people at the lowest level of income got back to where they were prior to the crisis faster than anybody else. And as you go up the income stream, it came back, but in terms of the way we responded, there was this ongoing income divide, but the pandemic itself didn't make it worse. It makes it look like it's worse, because if you look at all those furloughed workers that worked in restaurants and bars, but if you look at the income that was provided to help them, that really mitigated a lot of that income gap. So it's not, it's an issue, but it's got nothing to do with the pandemic in my mind. It's got more to do with the disruptions from innovation that have been going on for the last decade and a half, 2 decades, really.
Yeah.
If I could just add one point. So if we had this graphically, you would see, to Jim's point, household income is at an all-time high, despite having 8 million fewer employees in the labor force, which is an astounding thing. So we went above and beyond income replacement. So to the strength of the consumer, I agree wholeheartedly with Jim. I don't think the consumer has been ever in a better position, right? When we talk about inequality, I've read a lot, and I'm sure this is not, this is not science, this is not a novel statement, but those who in our society have more assets as part of their net worth, whether it be stocks, bonds, portfolios, houses, they seem to be doing better because, as Jeff mentioned, everything has lifted higher. But from an income standpoint, those on the bottom quartile are far superior to where they were 12 months ago because of all the extraordinary measures. So it is a testament to our response. The question is, maybe in the future, and I don't have a thought about this, but is this now the playbook going forward? I mean, we've shown we have the ability to put money directly into the hands of consumers and individuals and small businesses. Is this the playbook going forward? Or was this an extraordinary measure for an extraordinary crisis?
I think, segueing into, how some of that money got into the pockets of businesses and consumers was through the banks. I think all of you guys work at banks. I think where this recession was different than 08, 09 is, the banks relatively came through unscathed. Ahmed, do you maybe just want to talk about, how banks have handled, this crisis, credit wise, how they're doing, what the future outlook looks like for the banking system?
Yeah, I mean, in general, if you look at the history of recessions, those recessions which involve the financial system or banks are typically very sharp, very painful relative to a normal business cycle recession. As you mentioned, Colin, in this recession, the banks have kept a very high degree of capital and do enjoy a very high degree of liquidity. I think the using of the bank's infrastructure to facilitate the PPP program was a novel idea, and it was a great way for the federal government to reach a number of small businesses, and probably in as efficient a manner as possible, right? There's always going to be graft and a little bit here and there on the margin, but it was a phenomenal use of the bank's infrastructure to the point where I think the banks did a service by going about this. Just anecdotally from where banks are, right now, obviously banks are flush with deposits because of the liquidity sloshing around. It is astounding how much the market has changed over a 12-month period of time from where we were, where banks were probably a little bit more on the skittish side about deploying capital to whether it was commercial real estate or just in general in business 12 months ago, to the point now where it's probably as competitive as an environment as I can recall, right? It's a very borrower-driven market. Banks are cutting prices. All of the concepts of, on the commercial side, LIBOR floors, it's gone, right? It's a very competitive marketplace right now. So it's just amazing, just from my vantage point here at the bank, how competitive the dynamics have shifted. No one, in my opinion, could have expected it to turn that quickly, but the banks, to your original question, seem to have come out of this in relatively a strong position.
And what are your guys' thoughts? I think there's still stimulus being injected into the economy, and it looks like that's going to continue for some time. At some point, I think there's going to be a pullback in terms of that support and, safety net. If we look at bankruptcy trends over, period, it continues to trend down even through the economy, or even through the pandemic. Do you think at some point, these maybe zombie type companies or maybe commercial real estate, or where do you see, trouble lurking in the economy? Because it all sounds pretty good as we've talked about. I'll throw that to anyone. I don't know if Jim or Ahmed or
I guess it comes in the next recession, because this is the kind of thing you don't really discover these problems until you're in a new downturn, and if it's a more traditional kind of downturn, like you have inflation problems, the Fed has to be a little restrictive, then you don't get all this fiscal support. This fiscal support made absolute sense because our economy was in good shape before this happened. We didn't know how to manage the burden on the hospital system, which is already full of flu patients. So we had to lock down the economy. So it made a lot of sense to do this. I doubt that we'll ever see a repeat of this kind of response unless it's a crisis that we impose on ourselves. So I think the next trouble comes more traditional. It comes from the next recession, which, by the way, I think this crisis is probably pushed out further into the future. So it's not something you have to worry about right away, but it's probably for the next cycle.
Even commercial real estate. I mean, I know, anecdotally talking with, just people are downsizing offices. People are working from home more permanently.
Well, we don't know. See, because if this is the new normal, this is what everyone's worried about. What is the future demand for housing or office space? Well, but as you may notice, everybody's in a rush to get their workers back to the office. So this is a day by day changing. And I think this is not the new normal. I think, we all love the idea that we don't have to commute to get to work, but you forget there's a lot of benefits of being in the office. And that's what employers are really focused on right now. This is how you build culture. It's a team sport. You need people in the office. So I personally think it's way too early to rewrite the story about the demand for office space, because if the vaccines are effective as they seem to be, and we get this behind us, there's really no reason to think that we won't be going back to sort of in the way we were. And competition will probably drive it there.
I agree, right? If our competitor is meeting with a client or a prospective client, then you better bet that firms will start to do that with them. I think competition will drive us back. I've tried to make the trying to give some perspective about New York City. It's been through a lot worse than this. And before this pandemic transpired, everyone wanted to be in New York City. So we know cities eventually recover. It will eventually fully recover. I think it is just in our nature to want to be, we are a herding species and we want to be with one another and take advantage of those things. I think there's going to be buyer's remorse from those people that moved out of the city and moved way away, and that firms may get a little less friendly on commuting. Maybe it's 2 or 3 days a week that we're in the office to start, and maybe it's crawl, walk, run. But I agree with Jim. I think eventually we get back to those areas. So again, speaking of turnaround, I would play those short-term disruptions in longer-term trends as we as humans, where we were in a steady state before the pandemic. I think we eventually get back to that. Maybe it's kicking and screaming to some degree for some, but I believe we will find a rhythm. Maybe it's not the exact same rhythm that we had before, but I think it's more similar than most people think.
And what about, I think you mentioned, Jeff, New York City. I mean, I think all of us know people from New York and from LA, and they've moved to Miami or they've moved to Austin, Texas. I mean, what do you think some of the implications, for the United States politically, economically, are for some of these changing demographics? I mean, I think New Jersey is now the highest tax state in the economy, in the United States, making it more difficult to probably want to live there. I mean, what do you guys see as some of these changing trends across the United States?
If you give me 30 seconds, I think COVID-19 was much more of an accelerant than it was a game changer. I think these things were already in place: work from home, telemedicine, all these trends that took place during the pandemic were already transpiring. Technology already existed, and I think it really might allow us to live in more places, to work in more places, to not need to be in Silicon Valley. That Miami is now the new tech center, Austin, Texas, right? There are a lot of these cities, opportunity zones are popping up everywhere in trying to diversify innovation. And I think that's the start of a longer term trend. Jim or?
Yeah, I agree. And the pandemic probably did accelerate things that were already in place. And the things that were already in place were two in particular. The nation is aging. And when you look at the flow of the population from state to state, we're kind of migrating out of the Northeast, out of the upper Midwest, into the Southeast, into Texas, into the mountain states. Mountain states is probably San Francisco, tech center. And so part of this is demographic. As people age, they're kind of moving maybe warmer climates. But the other part that's sort of been brewing for a while is the tech belt, the West Coast, got really expensive during this last decade. And so I've always thought we're going to be seeing an organic rebalancing going on in the country. And it was the way to understand why the West Coast were starting to slow down in population growth, and Utah, mountain states, Denver, Texas were booming. And so if you're in the real estate business, it matters where you're located. For the nation as a whole, our population is slowing down. And by itself, you would say, well, that's going to feel like Japan. But because we're all in motion, the commercial real estate, the infrastructure needs kind of flow with the public. And so there's a real boom going on in much of the country and a slowdown in other parts. That's useful to keep your eye on.
And you mentioned just briefly the changing age demographics. How is that? The baby boomers are now starting to retire. I mean, is that, you mentioned immigration reform? How does all of that play out in terms of being able to manage the debt, the U.S. debt load? I mean,
that's the problem. That's the problem. This problem began in 2008 when the first wave of the baby boomers turned 62. So this has been going on for the last decade, that the growth of the working age population is slowing down really dramatically. It's about 25% of what it used to be 10 years ago. And what that means is, this is why everybody's complaining. I can't find people. I can't find workers, because my 65-year-olds are retiring and they're having a hard time finding a 22-year-old that can step in. And businesses tell us there are 8 million jobs they can't fill as of March, during the middle of a pandemic. So this is telling you it's a real thing. And it's really at the heart, this is in a way you could say, well, it doesn't really matter if our population is growing more slowly. What really matters is what's happening to our living standards. The problem is that the promises we've made are all based on the idea that we could continue to grow as we have been. But if our demographics is slowing down, then the only way to offset that is if we had immigration reform, we could maybe fill some of those jobs. That would help a lot. But if you can't do that, you got to figure out some smarter way to figure out how to get the economy moving faster. And innovation, investment is the key. Raising taxes doesn't help that problem.
Yeah. Well, I know we're coming up on an hour. Kind of want to give all the panelists, a last word, or I know it's cheesy, but sometimes ending these things with what keeps you guys up at night, what's the biggest risk, what's your guys' last parting thoughts to all the people that are on the webinar today?
I guess maybe I'll just give a couple words and I'll turn it over. In terms of what keeps me up at night, I mean, obviously when the weather is like this in Pittsburgh, I'm as happy as can be, right? We talk about the shifting demographics and where people are coming. We're going to get more people in Pittsburgh. But in all seriousness, what really keeps me up, kind of twofold. I mean, you mentioned before, and I kind of, I'm a rates guy. I think about inflation. I think about the impact that inflation, not from a negative standpoint. We have to understand, like, there are supply disruptions, but there is also a demand explosion, right? What does this end up doing? Inflation is a regressive tax, right? As much as we're trying to stimulate the economy and we talk about income inequality, inflation ultimately hurts those in the lower quintile. So I do think about what if inflation continues. I don't think runaway inflation, but simply what if it continues? And we didn't talk about this, and obviously this can go a multitude of different ways, a conversation like this, but there are always geopolitical risks. And we didn't talk about China, and that's the one that's sort of on the radar, a strategic miscalculation, right? So to say, if you have the two largest superpowers in the world come to heads over something such as Taiwan, then the repercussions could be quite large, right? And we won't get into the geopolitics here, but that's something that when you ask, like, what could possibly come out of left field, that's something I think most people should have, if they don't already, on their minds. And that's all I got.
As far as issues, we are going to get inflation in the short run. It is a lot easier to close an economy down than it is to open one up. And we are seeing that in spades. Demand is turnkey and supply is not. And you're seeing it in everything from, materials prices, especially. I think, lumber is probably the poster child for sort of what can happen in a market where demand is huge and supply has been, preparing since is at levels really since the great financial crisis, where housing was sort of taken out to the woodshed, no pun intended. So I think we're going to get a bout of inflation, and the market's going to wrestle with, in the short run, it's going to wrestle with whether or not that is temporary or not. And we're not going to know until we're sort of on the other side of it. So I think you got to buckle up. All history teaches us that after the first year of a bull run, which we've had, that the second year is a lot more trying. You got to work a lot harder for your return. History teaches that you should be buying those dips, buying that weakness. That is still our recommendation to our clients. For those of you that are in turnaround, you may have prices come to you down in here if you sort of wait and tactically sort of move some money around, knowing what you're playing for a longer term trend. That's what we're having our clients do with cash on the sidelines or liquidity events that they've had. But I am glass half full. I mean, I get paid to worry, but I also get paid to be right. And I think, as was mentioned by Jim, I think we're in the third inning of sort of this economic expansion, and it's not going to come without fits and starts along the way. But I think as long as inflation remains decently well contained and the Fed waits to see the whites of the eyes of inflation, and waits to take the punch bowl away, maybe eventually, we have probably some good room to run in here before we come to that period of time.
You know, what keeps me up at night, it's not a bad thing. What keeps me up at night is trying to figure out what in God's name is the equity market smelling. Because if I went to sleep when I got out of grad school and I woke up today, I would either have to conclude that the equity market is a massive bubble like the 1920s, or there's something going on that the market has picked up a scent on. And what I mean by that is, and the reason I wake up a lot thinking about this actually at night, because I'm trying to get my hands around it. And the problem is, and what I'm referring to is, the value of the U.S. stock market today is twice the size of the U.S. economy. In all my time, I always thought you could rationalize why the value of the market ought to be about equal to the size of the economy. But in the last 2 decades, this is what's been evolving. And the problem that I have as an economist is everywhere I look, the things that I learned in school don't apply to what I'm seeing. The inflation dynamic is different than I learned. The Fed is behaving differently because of that. The innovation that's going on that allowed us to transition from working in the office to this way we did it in the last year. But I think the real thing that's going on that must be part of this is, and my friends say to me, well, why are you obsessed with the U.S. economy as the reference point for the equity market? Because the world around us is waking up and developing. And there's a lot of GDP getting created around us, and our companies are involved in that. And so I think what I'm trying to figure out, what is the market smelling? Because I've learned over my career to respect what market signals are telling you. And this didn't happen overnight. This has been going on for a couple decades. Anybody who has been fortunate enough to have been in the market, working, saving in the last 2 decades is probably the luckiest generation on the planet ever. And this is what we're dealing with. So I think we got to figure out what is this about, and what is it that the market, is there reason to be optimistic? I think so. Does that make so when you see the kind of thing, it makes people like me much more humble about having an opinion about the equity market. And when I hear people say this is a big bubble, I think, well, it may look like that, but you know what? If you poke behind the scenes, you're seeing a lot of things that you did not expect a couple decades ago.
Well, I would ask you, Jim, was there $12 trillion worth of negative yielding debt when you were studying economics, or is that a new phenomenon?
I didn't know what the concept meant. I can't even today explain why 10-year German Bund yields ought to be negative. That makes why not just put the money in the mattress? That's what I can't figure out.
Yeah.
Yeah. No, we certainly were not thinking about that. It was all about inflation when I was in school.
Yep. Well, maybe it will be in the future, but all right. Well, David, I think that's all we have for today's panel, but I'll kick it over to you. But thanks, Jim, Jeff, and Ahmed. It was great catching up with you guys and great insights.
Yeah, thanks, Colin, and thanks to our panel. I think it was not only a really great discussion, but I think very timely when we think about what is literally broken over the last several weeks in terms of inflation, in terms of employment, the debate over additional stimulus, the debate over taxes. So I think we were really lucky tonight to have this panel who can or could give us insight on some things contemporaneously as they're breaking in the economy. I want to thank everybody else who was on today for attending. Like in our other programs, the survey link will be emailed to you following the program. Please, if you do have time, provide your feedback. It's greatly appreciated, particularly as we move forward with additional events. Just a real quick note, our annual golf outing is on the calendar now, set for September 20th of 2021. We'd welcome sponsors and participants. So please stay tuned to your emails, as we'll be getting out additional information, not only for the golf outing, but also for fall programming. So with that, I hope everybody has a great night, And we look forward to having you again at our program in the future.